Good afternoon, everyone, and welcome to another one of Avant-Garde's free educational webinars. We are happy to have you all with us today as we learn about how iron condors work. We have Vlad Karpel here and Keith Harwood both to go over this topic with us and really getting into this defined risk income strategy. Vlad, Keith, are you with us?
Yes, hopefully you can hear me okay.
Yes, there you are. Yes, thank you very much for taking the time today to speak with us all. Vlad, when you're ready, you can go ahead and share your screen and pull up your presentation. And while you're doing that, just want to say welcome again to all the attendees live in the Zoom room with us. Thanks for taking time out of your schedules. And as a reminder, if you have questions during the presentation, feel free to type those into your the webinar chat or the Q&A, and we'll address those at the end. All right, Vlad, I can see your presentation, so feel free to begin when you're ready.
Perfect. Thank you again, Natalie, for organizing this event and AGT for hosting it. And today we're going to talk about one of my, favorite strategies, iron condors. Especially I think for current market conditions, I think it could be appropriate. It's a defined risk income strategy, so we're going to go through some examples, what to look for, and when to use the strategy and when not to use the strategy. That's the goal for today. For those of you who are new, welcome. If this is your first live event, do me a favor, type in first inside of the questions, and let us know if you have used iron condors or not, or if you used options. So as a strategy, we definitely want to make sure that we answer your questions, whether you're new to options or whether you're an advanced option trader. This is more of an advanced option strategy because it consists of 4 legs, but ultimately, once you understand one, then you can apply the same logic to 2, 3, and 4. It's probably like with kids, first kid, second kid is different, but third, fourth, it's kind of just the same thing. Moreover, I have 4 kids, so that's I can speak from personal experience. But that's my background is in technology. I worked in Chicago, several startups here in Chicago. Always enjoy fintech space, brokerages, hedge funds, and newsletters. And that's my background. I've been doing this for the past 25 years. On technology side, building AI models, using latest advances in AI, neural networks, and providing signals. And Keith worked with Keith in the past couple of years. Keith, you want to go over your background?
Yeah, absolutely. So, a little bit shorter than Vlad, but close. I've been in the markets for a little bit over 20 years now. Not quite the 25 years, but I was a math and economics undergraduate at Notre Dame, graduating in '05, and I went and became a market maker on the CBOE floor. So options market maker in the pits, trading thousands of contracts per day. A little bit different today, now being on the retail side of things, obviously a lot more selective on the trading setups. Really excited to talk about Iron Condors today because it's a great strategy for implementation for individuals looking more at like range-bound trades as opposed to purely directional focused. I think there's a great opportunity here. It's definitely a strategy that I think can be utilized by anybody from professionals down to beginning traders as they evaluate what works best for their portfolio. So yeah, we've been doing this. I've been doing the educational side for, gosh, 8 or 9 years now. Really excited by this topic. Looking forward to discussing further with you guys all today.
Great. Thank you, Keith. Disclosures are important. I know Natalie already went over it, but I think it's important to understand that I'm a founder of Yellow Tunnel and TradeSpoon, and the relationship between Yellow Tunnel, TradeSpoon, and Avant-Garde trading. You can always pause the screen to read these disclosures, but this is an important slide. And I'm not a financial advisor. I'm here for educational purposes only. All right, what is an iron condor, right? So again, let me see. Did you guys tell me how many of you actually trade options or stock? If you can type it in. Doesn't look like. Last time there were millions of responses. Today, not a lot of response. Um,
Yeah, everyone's feeling a little quiet today, it looks like.
all right, Michael, welcome back. One. Okay. So some of you traded options. Because again, options are derivatives, right, of underlying asset class, which is a stock, right? You can trade stocks, and stocks usually directional, right? You can you can buy stock, or you can short stock, right? Depending on your view. Options are derivatives were created originally to hedge your stock position, right? So you can buy a put, right? And you can hedge your positions. Or you can sell a put, right? Let's say you sell an out of the money put, then you can lower if you get a sign, you can get, uh, delivery of the stock at a lower cost basis, right? So also very popular strategy. And then you have call. If you're bullish, you can buy a call and reserve certain level or strike price at which you would also get a sign if the option expires in the money, then you have right to purchase the stock at a certain price. So that's kind of a basic gist of options. I mean, I would say you would learn one, and then you can kind of derive the rest of them, right? You can buy a call. In this example, I'm using spiders. Let's say spiders is trading at 750. Right now it's 730, but you think it's going to go to 750, so you can buy 750 call, right? With the idea that market is potentially range bound and will revisit all-time high after Micron earnings. So if that's your opinion, you can buy call, right? Maybe it expires in July, maybe August, maybe next Friday. There's different expiration dates, and it gives you a right to buy micro spiders at 750 if it reaches that level. If it doesn't, then it will expire worthless. So iron condor basically consists of four legs, right? Both puts and calls. It's a defined risk option strategy. I mean, the main point is that it profits when underlying stay with defined price range, right? It combines short put spread and a short call spread. So the idea is that you sell in premium, right? If you look at the put, you're selling more expensive put, right? And then you buy. And usually, unless you're an experienced trader with a large portfolio, you do not want to sell naked calls and naked puts, right? So if you want to collect more premium, you have a large portfolio and you've been trading for 10 years and you understand the risk of short options, then you don't have to hedge, right? You just sell put, you sell call, and as long as market range bound, you're collecting more premium. The risk is obviously if the volatility picks up, right? Let's say that decides to raise interest rates. Right? Next press conference, Walsh says, we need to raise rates, right? And maybe not in December, but as soon as September, right? If market doesn't expect that news, and if it happens, then your market could sell off, right? The volatility could pick up, market sell off. And if you sell a naked put, you could lose a very large percentage of your portfolio. So in general, 9 out of 10 times, or 9 out of 10 people, especially if you're new or you have a limited capital, you do not want to sell naked options and naked calls. Then what do you have to do? You have to give up some of that premium that you collected and hedge yourself. So you buy a lower put, right? Protection leg. Right? I like that term. Income leg is where you sell, and protection is you protecting yourself in case market sells off. And vice versa, right? You sell call, but what if Micron says that the demand for Micron memory and semiconductors and storage in general, there's no end in sight when the supply is going to meet the demand, right? The demand outpaces supply. They quadruple their earnings, and all of a sudden the market breaks out, and we're reaching 800 on S&P, right? If you short call, again, you potentially can lose a large percentage of your portfolio, which you want to avoid. So for that reason, you buy in protection leg, the buy leg. So that's an important concept. You collect some credit, you sell in more expensive put, you sell in more expensive call, right? Where you think the market is going to trade in the range. And the key insight, iron condors profit from time and low volatility, right? So if you think market reached some kind of equilibrium, right? Maybe we're not making new highs because everybody's concerned that Walsh is going to raise rates, but we're not, reaching lows because Micron just quadrupled their earnings, and Intel and Dell, they're all printing cash. Then between these two opposite forces, market is stuck in a range. Maybe it's 700 to 760, maybe it's 730 to 770. whatever the range is based on your level, you want it to stay either market in some kind of a either same volatility or low volatility, and you profit from time decay, because in both cases you're selling out of the money options. So Iron Condor in summary rewards market neutrality. Before I go into example with specific numbers, I think we're especially Keith, he's very mathematical and driven by numbers. So I'm going to go through some examples. So bear with me. But before we jump into an example of spiders trading at assuming 750, I think we had a little pullback. It's close to 735 now. Keith, anything to add on Iron Condor? What your setup looks like? When do you think you should use it? When you should think you should not use it?
Yeah, I mean, I think the big key, and you touched on this already, obviously, is it's got to be a situation where I believe the market or the stock that I'm looking at is going to remain range bound. If I believe there's a directional trend or a potential for a big move, then that's not the right time for me. We've got a big inflation number, a big non-farm payrolls number that could break the market out of range. That's not the right timing for my personal implementation. There are times where I like using them for earnings based upon or event driven based upon projected magnitude of move. But just generally speaking, especially when getting started, I think it's very much built on the idea that we have a choppy market that doesn't have an expectation that we're going to get a big move either direction in general.
Thank you. So when I created this example, spiders was trading at 750. Let's go to this example, right? So let's assume spiders is trading at 750 and using 45 days till expiration options. That's probably the standard, right? You look at 35 to 50 days till expiration. You look at monthly expiration. You can do July. July is a little bit less than 45 days now. So August, right? You would go into August. That's the traditional. Because weekly options and daily options, 0 days to expiration, this is more of a recent invention. Traditionally, there were monthly options. Even though spiders now have 0 days to expiration, you can do Iron Condor for next Friday or even this Friday, right? Some people do that as well. Neutral outlook, right? You think you can argue the bullish case why market should rally because of the AI and how much capital investment is there and broadening of the rally, right? Small caps made new highs today. Value stocks made new highs. So you can argue the bullish side, but at the same time, interest rates are important. And if they're going to rise and financial condition will tighten, ultimately these billions and trillions of dollars that the AI companies are raising will be hard to refinance, right? So if you can argue both sides and market stays in the range, then you have kind of a neutral outlook and you want to continue collecting the premium, right? Because your stock's basically not going anywhere and your portfolio is not doing anything. So if you want the supplemental income, then the idea is that you can sell 740 put and buy 735 put, right? If you don't think market is going to drop to below 735, which it hasn't in the past couple of weeks, right? So if you think 735 is where the market is going to expire, let's say by August, right? Then you do 740, 735. If you have a larger portfolio, instead of a $5 spread, you can do $10 spread, but then you can take, potentially higher risk or you commit in higher capital. So that might not be ideal. But you look at some kind of a support and resistance levels. If you think it's 740, 735, then you can do that on the put side. Right now, market is trading at 730 or 735 last time I checked. We haven't breached 72, 720 or 725, so then you would go to maybe 720, 710, right? But for the sake of example, let's assume you don't think we're going to drop below 735 and stay there. Then you can sell 740 put, right? Delta 20. So basically says 80% of the time, in 45 days, we should not be below 740, right? Assuming spiders at 750 right now. So you look at the delta as an indicator of what the short option to be. In this case, you're receiving $1.75 credit. Again, in case I'm wrong and spiders break down and reach 700 level, right? Because we're raising, Fed decides to raise interest rates or geopolitical risk, right? The escalation in the Middle East or any other reasons. Then I do want to pay the protection, right? So 75 cents received, 85 cents paid. My brain is a little slow today. Maybe 90 cents, right? 90 cents. You're making 90 cents on the premium that you receive. And then the same idea on the call side. If you don't think by August we're going to make new high, right? From seasonality point of view, June has been a good month for the past couple years. August, September traditionally has been either neutral or bearish, right? So you say, listen, the top is set. Micron was up 20%. I don't know where it's trading now, but it gave up more than half of its gains. Even they quadrupled their earnings. So you might say, you know what, at this point, we're not making new highs. So then you sell 760 cents, 765 spread, right? And again, you're receiving $1.75 because you sell a more expensive call. You buy a long call in case, worst comes out and says we're going to lower interest rates, right? That is also if inflation data drops, right? If CPI and PPI data drops next month, because oil prices basically at the pre-war level, then potentially Wash can come out and say, listen, inflation is down, employment is steady, we're fulfilling our dual mandate, we're going to lower interest rate because that's what everybody wants. Great. Then the market is going to break out and you don't want to be with the short call, right? So then you collected 85 cents, right? So 85 cents, all right, 90 cents, $1.75, right? You're receiving $1.75 credit, right? Because you sold short put, you sold short call, you receive $1.75. Each contract is 100 shares, so you receive $175 credit. Max loss is $325, right? The width of the strikes, I'm doing $5 spread on each leg. If it was $10 strike, then it would be $10 minus the credit, but it's the difference in strikes minus the credit you receive, right? And then you have your profit zone. Right? If we drop close to 735 or we go higher than 761, right? The credit that you receive at $1.75, then you're going to start losing money. Any questions? How many of you guys done Iron Condor? Has anyone done Iron Condor? I know if you're a Yellow Tunnels or Tradesman subscribers, you've done it, but anyone traded spreads, especially spiders, pretty popular strategy. All right. Yes. Thank you, Jim. Appreciate it. Thank you for participating. Yep. We have multiple Jims. A lot of Jims today. Michael. All right. Thank you. Keith, anything you want to add on this example?
Yeah, I mean, I think the biggest element I'd like to add here is that one of the keys here is that the max loss is not that both these trades lose, i.e., if I lose on the call spread because we ran up to 770, my put spread's going to expire worthless. So I'm going to have a little bit of offsetting profit. And that's what helps with the balance of this is that even if either the put spread or the call spread independently, maybe a lower expected return or a lower probability scenario, by combining them, I know that at least one side will work and help offset the loss on the other, and it allows me to generate enough income at $1.75 per spread instead of 90 cents or 85 cents that it helps push the odds significantly more in favor of the person selling the Iron Condor.
Thank you. I appreciate it. That makes sense. So I'm a very visual guy. Profit loss diagrams, you can find them on the internet, but it's important to visualize, right? If you've never done four-legged trades, I remember first time I did it, you don't see it, right? When you close your eyes and you're asleep, and you want to dream of Iron Condors, you're not going to see it in your head if you haven't done this. So it's important to look at these type of examples, right? And just your axis is the spider's price, right? 730. What happens at 735 level? What happens at 740, 760? Let me see if I can draw it. Right, so 735 is important level, 740 level, break even level. These are important data points. And we're looking at the spiders x-axis at different levels at expiration. and your y-axis is the profit, right? You're making $175 if we stay below this level, right? So maximum profit if we stay below 761.75, right? So that's the level where you're making maximum, and this is your maximum profit, right? You can't make more money than the initial credit you have received, right? It cannot happen, right? And these are the levels that you will make money. But if Warsaw lowers interest rates, right, then we're going to be at close to 800, right? And then that's your maximum loss. You can lose more than the difference in strikes, minus the premiums that you receive, and vice versa. If Fed decides to raise interest rates or oil prices goes back to 200 level, right, then most likely spiders will not hold 735 level, and market is going to sell off. This is important. This is kind of what the maximum, understanding the maximum profit, maximum loss. Keith usually likes to say that your maximum profit should be 30% the width of the strike. So if it's a $5 spread, then $1.75 is a reasonable credit, right? And then this is your loss, right? So 30% you're making money, 70% of the width potentially losing money. Any questions on the profit and loss diagram at expiration? And just remember the probability that we will expire at 765, right, is a lot less than before now and the August expiration. If you trade in August, we're going to reach that level, right? So you could reach the 765, but then if there's a lot of open interest, then you'll bounce back and revert to its mean. Any questions on the profit and loss diagram?
Yeah, Vlad, we did get a couple of questions here. Is there, in your opinion, any sort of a point when you might roll one of the legs when one side is threatened, or if it's not going the way someone wanted it to go?
Thank you. Keith, you want to take this one, or you want me to take a stab at this?
I can tell you, yeah, for me, I think the answer is rather than rolling it out, that's just going to add risk to the trade. I usually would prefer, rather than rolling it out, just looking towards the close. So set a stop loss and be firm with that is the approach that I normally take on it. I.e., if the idea is that if we get above 765, then that tells me that S&P is no longer range bound. Well, then I don't want to change my structure just to have a different iron condor to try to reduce my loss. It proves my original thesis wrong, and so I shouldn't have the trade on as an iron condor anymore, and I have to look for a different trade. So a lot of times there are times where adjusting a trade is warranted and merited. If the adjustment is simply to try to reduce the loss or change it so that I can, try to salvage some money, I end up saying that I'm doing it just to manage my loss, but not because I actually believe in the trade. And if I don't actually believe in the trade, then I shouldn't be making modifications to it. I should be exiting it.
Gotcha. Thank you.
Perfect. Thank you. The strike selection, right? This is timing is difficult but it depends on your trading psychology, your profile. Do you like to make quick decisions and trade very often, right? Then you can do weekly options, right? You can go to next Friday and do the iron condor if you think that it will trade by a certain range. But strikes are very important, right? So here's for the short strike, the income lags, the delta, and usually it's 70, somewhere between 70 and 85, right? You look at the delta for the short leg, which is important, right? Delta gives you kind of a proxy for probability that it will expire out of the money, right? And you want higher probability. Distance, you can look at one standard deviation roughly from the current price. You can look at Bollinger Bands. You can look at support resistance levels. You can look at high open interest. I like to look at high open interest, 50-day moving all-time. Right now, market is trading between 50-day moving average and all-time high. So I can say, okay, all-time high, there's a lot of open interest at all-time high. 760, and 50-day moving average, let's say it's 730 roughly. Okay, so it will trade somewhere between 730 and 760 right now. Day still expiration, right? Theta to gamma ratio, 30 to 60 days. That's classical example. Symmetry equal delta on both sides. Short, if they're not equal, then you have more risk on one side versus the other. NIV rank, you want to have enough premium to justify the risk taken, but you also don't want to trade if you expect volatility to pick up. Right? So IRV rank 30, greater than 30 makes sense. Otherwise, you don't have, if you're not collecting 30% the width of the strike on a $5 spread, if you're only collecting, let's say 50 cents, a lot of people say this might not make sense, right? Because one bad, your probability of making money is going to increase, but return on capital is going to decrease, and one bad trade, and then it can wipe out multiple good trades. The long strikes, protection lags, right? These long call and long put that you hedge in yourself in case market is going to have a sharp, more than one standard deviation move to the downside, or more than one standard deviation move to the right side, some kind of a unexpected data, right? Whether it's escalation in the Middle East or interest rate, path of interest rates, though that could definitely take market outside of that one standard deviation move. Right? And trading is always distribution of possible outcomes, right? And you look at your probability curve, and you just always think about, are we going to stay within one standard deviation, or are we going to make two standard deviation moves? So in this example, $5 spread, typical $10 for more credit, more risk, right? And strike price is important. At 750, I mean, if it's a liquid, you can do it $5 spread. But some of the stocks that are less liquid and don't trade in pennies, you might not be able. And like Micron, it's very hard to trade a $5 spread on Micron, right? So you would have to go $10 spread if the Micron is trading at 1,000. Balance equal width on both wings. That's a typical setup for iron condor. You can obviously, if you think, you can have broken iron condor where, the width is different on each side, but then you're taking more risk. Net credit should be 25 to 30% the width of the strikes, and aim for 1-to-1 to 1-to-3 risk versus reward and capital requirement with minus credit. Keith, anything on strike selection that stands out to you?
Just something that I saw in the questions. One of the notes was asking about using weeklies for iron condors, and I think that's a valid approach, just knowing that when using shorter time durations, it's going to be a tighter range. So if I'm looking 45 days out, I may be looking at 700 and 780 as a range. If I'm just looking for tomorrow, my range might be 730 and 735. So I put a lot more short-term risk, but quicker potential payout. It's all about how comfortable people are with their short-term ranges versus medium-term ranges versus long-term ranges. But I think a good starting point is in that 30 to 60 days. And as comfort grows with short-term ranges, can certainly use shorter time frames. Going longer than 60 days, it usually doesn't pay off because this is very theta driven, and there's not a lot of theta benefit to having a 6-month out iron condor position.
Thank you. All great points. On iron condor, because you have 4 legs, open interest and positioning is extremely important, right? So this is a chart of where right now, usually the highest open interest is, and the volume is at the strike the market is trading. So if it's trading at 750, this is where you have highest open interest. As we're approaching close to 8,000, the highest open interest is actually at 8,000, but you might not get enough premium to sell, 800 strike on SPY or 8,000 on SPX. But positioning is very important, right? You want to look at the max pain point, with highest combination of open iron tends to act as a magnet into expiration, right? Perfect centered for your iron condor. Put wall, right? You want to look at the put wall and the call wall, right? Where is the highest open institutional resistance? Where is the highest call open interest? Where is the highest put open interest? And more likely than not, let's say you trade in August and you look at July and August, this is where most of the position will be. Most likely, those will be important levels where the bears and bulls are gonna fight for, and those are the strikes you might consider selecting. Liquidity matters, right? Slippage trap, right? Why a spider's ideal? You want something that trades in a tight bid and ask range. Otherwise, you would have to, pay extra. You collect less credit. It'll be hard to exit from those spreads. So you want to trade liquid options, right? That trades in pennies or at least in 5 cents. And very important consideration, right? Use limit orders, try to target the midpoint. If the natural bid and natural ask are apart, you can always walk the limit, but you start at the midpoint to get a better execution price. Execution price is extremely important when you trade iron condor. And you want, open interest over 1,000, daily volume over 500. Those are very key points you want to consider. So key takeaways: sell premium on both sides, right? Puts and calls. Use open interest or to set the range. You can use Bollinger Band. You can use RSI, not RSI, but something that shows you the range, right? True range, ATR. You can use just classical support and resistance levels, 50-day moving average, 200-day moving average. Manage at 50% profit. Usually you don't want to wait till expiration, or you don't want to wait till the maximum loss, right? So the trigger point is if you get half of the credit, you would exit. If position goes against you more than by 50%, you would exit. You don't wait till expiration. Traditionally, 5 to 10 days till expiration, you want to close your position because gamma risk accelerates near expiration. Any questions? So again, you can always use AI Winston. If you've been in our presentations, you're already familiar with that. But if you log into your Avant-Garde account, right, and you go to trades, right, there's always this research API. It's AI bot that AGT offers, where you can actually type in, right? It knows about your account, so you can ask account-specific questions. Where's my statement? How do I look? What my positions are? But you can ask questions about iron condors, right? What should I use? Iron condor and spiders, right? Assuming spiders trading at 730. And it will give you an answer, right? You can always ask the AI bot that's trained on the educational data and trade on the proper data, right? And gives you help, right? So using iron condor, we still focus on setting up strategy where profits are maximized within defined price range. Assuming you expect spiders to stay stable in upcoming periods, here's how you could structure it. So I just did this independent of the presentation. It said sell 750, 760 call spread. Because we're trading at 730, not 750, and sell 710, 700 put. I would look at the prices, and if the risk versus reward is justified, and you don't think you're gonna break below 700 or you're gonna break above 760, then that would be totally valid volatility, right? When to apply, right? Low implied volatility, defined price range, neutral outlook, right? So you can always solidify. You can run it against AGT broker, right? But probably shouldn't use the word Winston, but behind the scenes, for the option specific data, it's using Winston, and you'll see it as at the answers. So that's Winston bot that can help you to train you and help you. You can ask questions, see what the bot says, and help you with strike price selections and open interest questions and risk reward. Very useful tool. All right, I know I always run a little bit more than I'm allowed, so I apologize. But any questions before?
Yeah, thank you so much, Vlad. We do have a couple of questions coming in. What's your opinion? Wanda's asking, can you use the same delta on the short leg if you're doing like a weekly iron condor should the delta be different for the longer, for the 30-day? And again, I know this is just your opinion.
Yeah. Well, delta will be different, right? Because the shorter the idea was you sell 30, delta 30, and the long you hedge with delta 10. That is the standard answer. I would look at support and resistance, and sometimes maybe do higher delta. You were saying delta 80, or like 80% that it will expire. You just always keep in mind risk versus reward, right? The higher the delta, if it's 90% probability that it's going to expire worthless, let's say SPY at 700. Well, it's a high probability that it'll expire worthless, but is it justified to take that premium? The premium might not be justified. So it's a combination of risk versus reward, right? Return on capital versus how much risk you're taking. I mean, delta 20, delta 30 is a standard answer, but you look at other components like high open interest, and that can move your delta up or down a little bit. But in general, you want to stay with that realm of, is the risk justified? And if it is, am I collecting, at least 20, 30% the width of the strikes of the credit? If it is, and you're close to these support levels or where you think the market is going to trade, then it's justified to take a trade. If not, then the setup the premium that you're receiving might not be justified for the risk you're taking.
Understood. Thank you. One other question coming from Mikhail is asking, can you go back to the first slide just really briefly? Not your intro slide, but probably the first one that has there we go. The definition of an iron condor, yeah. And just a reminder to everybody, you will get the recorded replay on this, so you can rewatch and pause and really study each screen as long as you need to. But yeah, thank you for doing that. Just a little flash. That, and then if you can go back, Vlad, just to your last one. So people, if anyone needs to contact Vlad at Yellow Tunnel for any follow-up questions, feel free to do that. If you have questions for Avant-Garde regarding our webinars or the whole process, definitely reach out to us over here at Avant-Garde. You can reach out via email using info@tradeagt.com, or you can call the team directly, 312-858-5748. And I want to thank everyone for taking the time to join us this afternoon. Thank you, Vlad. Thank you, Keith, for discussing this topic with us all. We really do appreciate it. Thank you for those who are participating in the chat and the Q&A. It's always great to have interaction. And we hope to see you all back at our next educational webinar coming up in July. So please check the site, check your inboxes, and don't forget to sign up. Until then, good trading to everybody. Thanks all.
Thank you. Thanks a lot, everybody.